Stocks versus cryptocurrency, which is better? In this video, I want to talk about the difference between stocks and cryptocurrency and share my framework of thinking so that you can get some inspiration to build your own diversified portfolio. This video is going to be broken into three main parts. First, I'm going to talk about the main differences between stocks and crypto. And then part 2 and 3 is actually going to be bunched together where I share my framework of thinking if I'm interested in a particular crypto or stock. And then ultimately, how do I size my position accordingly? Of course, my framework of thinking is very specific to my own circumstances and my risk tolerance. So take whatever makes sense to you and use that as a source of inspiration. As usual, if you do learn something new, it would mean the world to me if you could gently smash a like button somewhere around here. And no, this video is not financial advice or recommendation to do anything. So without further ado, let's go. So let's talk about the major differences between stocks and cryptocurrency. And in my opinion, there are really 4 categories of difference. You have ownership, you have volatility, you have regulation, and also uptime. With stocks, you are essentially owning a piece of a business where you are entitled to its cash flows and earnings both now and in the future. With cryptocurrencies, you own a piece of that currency, and right now it's mostly used as a store of value. Now, obviously that definition changes depending on the project because some projects actually have a real world use case. With volatility, stocks every 6 to 8 years tends to have a market crash. And these market crash drawdowns can be anywhere between 30% all the way up to 60% or more. But over time, our markets evolve, more regulation come into place to make sure we don't make the same mistake again. A good example of that is during the GFC, the banks didn't have enough reserves and they were over leveraged. So after the GFC, there was more regulation in place to make sure the banks had enough reserves and are not over leveraged. Cryptocurrencies, because it's so young, it's more prone to speculative mania. And these drawdowns of 50% or more happens way more often in the crypto market. That's mostly because a lot of investors probably over allocated money into crypto. And on top of that, they probably don't understand what's inside their crypto portfolio. So it becomes really hard to sit through a 60 to 80% drawdown when you over allocate it and you don't understand the crypto project that's in your portfolio. I'll talk about how I size my position so that I don't paper hand later in the video. I think the most beautiful thing being a retail investor is that if crypto is not my cup of tea, I don't have to do anything. I get to choose exactly what goes into my portfolio. With regulation, there's definitely more of that in stocks, and it's both a good and a bad thing. On the good hand, it protects investors and more confidence to allow institutional investors to allocate more capital into the stock market. Now, the bad thing is that because it's a centralized authority, so like for example, SEC in the US look after all of the stock market. In Australia, that's ASIC. When there is a centralized authority, sometimes the decisions and the regulations that they make tends to lean more towards, benefiting the institutional investors. With crypto, there is less regulation, and actually that's part of the appeal for crypto and why they were created in the first place. At the same time, because there is less regulation, it's more prone to speculative mania, and institutions don't feel confident enough to allocate more capital towards crypto. And then the fourth major difference between stocks and crypto is that stocks tends to trade Monday to Friday with the exception of holidays and weekends, but crypto is 24/7. There are definitely pros and cons of owning stocks and crypto. With stocks, it's a mature asset class, and there are plenty of players in the market. So the returns are just not going to be as good when compared to crypto. That doesn't mean that you can't find a company that will 10x in the future. It just means that it's going to take some time and those opportunities doesn't come around all that often. With crypto, the potential to generate a much higher return happens more often because those upsides are not exploited by institutional investors just yet. At the same time, because there is a lack of institutional investors, there's just going to be more paper hands leading to a bigger and more frequent drawdowns of at least 50%. If you don't believe me, the chart on the screen right now is basically Bitcoin from 2012, so the early days of Bitcoin to today. And in the span of 9 years, there's been 60% plus drawdowns. In the stock market, a crash more than 50% happens every 6 to 8 years, so it doesn't happen all that often. And similar to most people, I was introduced to Bitcoin in an economics class in 2013. So during that time, there was just no way that anyone could convince me there was a proper use case of Bitcoin other than illegal activities. But as time went by with more institutions on board and actual use cases, like for example, if I want to send money to El Salvador, companies like Western Union will take a pretty hefty fee off my transfer. Apps like Strike, that's built on the Lightning Network on top of the Bitcoin network, can enable those transactions at a fraction of those costs. So over time, I definitely became a little bit more open-minded towards cryptocurrencies, but still very cautious. Not to mention, the return of Bitcoin is very hard to ignore when compared to stocks or even gold. Over time, I created this framework of thinking for myself, and this applies to both stock and cryptocurrency, basically anything new that I want to be part of. The first question I always like to ask myself is, do I know anything about the tech? And this is especially true if it's crypto. And if I don't know anything about the tech, I will not allocate more than 0.5% of my portfolio. The main reason I still choose to put some money into crypto is mostly because I want to go learn about it. And if I don't allocate anything, I'm just not incentivized to go learn about it. And if I allocate too much, like for example, 3,000 to 4,000, I start to get a little bit anxious if that position does tank 75%. So I found that 0.5% is the sweet spot for me, especially when it comes to like research positions. Once I have a reasonable understanding of the tech, I need to size the opportunity, because why would you allocate more money towards a particular position if there is no upside? Now you can size the opportunity by technical analysis if you're a charts kind of guy, or via the adoption of the tech. Either way, I try to be pretty reasonable to my upside estimates, not too bearish and not too optimistic. So let me show you an example. With Bitcoin, I was always interested after 2017, but I just never really thought of it as being part of my portfolio because I'm a little bit old school like that, right? So during this period, I was paying attention, but I really started to think more seriously between September and October, and that's after institutional investors have started to jump into Bitcoin. So Paul Tudor Jones, which is a billionaire hedge fund manager, started to jump into Bitcoin in May. MicroStrategy, which is a business intelligence software company, decided to convert their cash into Bitcoin. And Square invested around 50 mil into Bitcoin. Then after that, there's actually a few positions missing, like PayPal should be here, Tesla should be somewhere around here as well. So there was just a lot more institutional adoption. And my thinking behind that is that, okay, if there was institutional adoption, so then the upside would at least be the previous height, which is somewhere around the $20,000 mark. So if I mark that, and from the time when I decided to add to my Bitcoin position at around 10,000 USD, that return profile looks pretty good to me, right? And I thought that this will happen in a span of maybe about a year, because generally speaking, Bitcoin's bull runs tends to go on for about 500 days. And September was really kind of the early stages of the Bitcoin bull run. So I thought it will reach around 20,000 in around a year's time. And that's one of the reasons why you want to go learn about the tech, because you can size the opportunity better so that you have more confidence allocating capital. With step 2, there's definitely enough upside in Bitcoin for me to allocate more money. Then the last step is to decide the max percentage I can tolerate within my portfolio. And I found that between 1 to 5%, I can handle the drawdowns of 60 to 80% with no problems. And if it does perform, then it'll meaningfully add to my portfolio. And the same framework of thinking actually applies to stocks that I'm interested in as well. So I would love to know what you think about my process of thinking. Do you think that is too rigid? Do you think that I should just YOLO a little bit more? And what about your own process of thinking? If you wouldn't mind, I would love for you to share that with me in the comment section below. So thank you so much for hanging out with me all the way to the end. If you did learn something new, consider gently smacking the like button right there. Subscribe to my channel, click onto the bell so that when I release future videos, I can let you know. If you're still bored, I left a video on the screen that I think it's incredible to watch next. And as usual, Otto will always do the honors, and I'm gonna see you very, very soon.